Coming up on Market to Market, a dramatic week of snow and wildfires. Two major government reports give guidance for the new year. Double the market analysis with Ted Seifried and Matt Bennett next.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because a pioneer, our name is our mission.
For over 45 years, Steiner Tractor Parts has shared your love of antique tractors. New parts for old tractors. Learn more at steinertractor.com or at 877-559-7887.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, January 10 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. The job picture continued to improve last month, counter to the convention where higher interest rates usually cut into expansion. Employers added 256,000 jobs in December and ending 2024 with the creation of 2.2 million jobs. The Labor Department did lower the figures for October and November by 8,000 positions. The unemployment rate fell to 4.1%. Also this week, a major series of wildfires swept through the Los Angeles area with the help of intense Santa Ana winds. And more than a foot of snow from Kansas to Illinois into Virginia started this week, which was followed by another system slowly moving from Texas to Virginia. Then there was the reason for our special programming this week, two anticipated USDA reports. Ted Seifried is Chief Market Strategist at Zaner Ag Hedge. Matthew Bennett is co-founder of agmarket.net. Before we hear from them, let's set the stage with this week's closes. Smaller than expected yield and ending stock sent the market higher in post-report trading Friday. For the week, the nearby wheat contract added 2 cents and the March corn contract improved 20 cents. The soybean oil trade surged on the announcement of a clean fuel tax credit. The March soybean contract gained 34 cents, while March meal cut $10.30 per ton. March cotton contracted 70 cents per hundredweight. Over in the dairy parlor, February Class 3 milk futures declined 37 cents. The livestock market was higher. February cattle added 473. March feeders put on 522. And the February lean hog contract increased to $1.77. In the currency markets, U.S. dollar index added 69 ticks. February crude oil found $2.35 per barrel. COMEX gold expanded $61 per ounce. And the Goldman Sachs commodity index moved more than 21 points higher to settle at 575.15. Let's get back now to Ted and Matt. Ted, this report, when you saw it, your first thought?
Yeah, wow. I mean, it was a rather bullish report compared to what the trade expectations were. As soon as I saw the numbers, I figured that we would be sharply higher, and we were. And then the next thought that crosses my mind is, okay, are these all the things that we've been talking about, you know, sort of behind the scenes for the past 4 months or so, that has all now come to fruition, and this is now the realization of that. And there's this old adage in trading, which is buy the rumor, sell the fact, and I'm wondering, is this the fact? So I spent the rest of the day kind of wrestling with that idea, Paul, and also the idea of trade expectations come from analysts like us, and when we're asked by the news agencies, they're not asking us what we think the U.S. national average yield is. They're asking us what we think the USDA is going to say on this report. And that's a big difference, because I think the market had been factoring in numbers, yield numbers, production numbers, carryover numbers that were lower than what the average trade guesses were. You have your computers, your funds, algorithms that trade versus expectations. But you think about how the dust settles here over the next few weeks, and I think there's a lot of people that have been pushing long positions for quite some time, expecting to see eventually the numbers that we saw today. And now that we have them, it really makes you wonder, are they going to continue to buy this market? Is there a reason to be bullish longer term? Or was this just the final realization of what we've been talking about since, well, corn's low was in August, beans was in the middle of December. You know, so I don't know. That's something that I'll be wrestling with for the next few days and going into next week.
Matt, did anybody pick up the phone and sell into this?
You know, there was a little bit for sure. I mean, whenever you look at farmers selling, you know, there was plenty of farmers selling today. And a lot of that was stuff that was already put in advance. And so there were offers that were hit. I mean, we were struggling to get up and above 460. You know, some farmers like, hey, you know what? If I could get to 470, I'd go ahead and sell some corn. Well, guess what? You had your opportunity. But in a day like this, sometimes if you don't have your offer in, you're not going to get a hit. You know, when I saw this report today, I thought it was pretty interesting. You go back to some of the things Ted was talking about that we've seen over the course of time. Obviously, excessively dry August. We know it robs some bushels, but the other thing is the moisture content coming out of the field. I mean, a lot of 11 and 12% corn coming out of the field. 9, 8, 7% beans. Those things factored their way in eventually, but a 3.8 bushel yield drop for me in January is quite interesting, that we're just now figuring out that it's a 3.8 bushel yield drop. Last month, you raised demand 200 million bushel. You took 75 of that back this month. So that's it's not altogether uncommon to see yield drop and then them drop demand. I mean, it's something that they've done in the past. But to me, I think that we knew that this yield was maybe a little bit lower before this. But bottom line is today, it was somewhat of a gift for the grower. I mean, quite frankly, I hope that the grower will look at it as a gift, because a gift's not a gift unless you accept it. So I think we've got to at least take a look at this, you know, and what's Basis going to do from this point forward? I mean, you've got to assume, you know, with an end user that has bought a lot of corn here in the last few weeks, Basis is going to have to widen out here whenever you take this kind of a jump up in the market.
You like, though, the basis is going to change? You like that idea?
Yeah, I think so, right? Especially after today, there was a lot of resting orders that were in there, you know, because go back to this past growing season during the summer, we had a lot of guys had resting orders in there well above the market, which the year before when we had those 3 rallies, they got hit and the market came back down, and it was like, oh, I'm glad I had those in there. We did that again this year. Market never rallied, never had that spike to get those resting orders. So now going into this, you had resting orders, but they weren't pie in the sky, super high resting orders. They were fairly close to the market. So a day like this filled a lot of those orders. A whole lot of cash movement happened today and even leading up to today. And so I do think your end users are probably pretty satisfied for the time being. And I'd say that for both corn and soybeans at this point.
So I guess we always talk about the farmer opening up the bin door. It sounds like those who collect, the end user, is going to shut and not accept anything more. Do you concur?
Yeah, I don't know if they're going to shut and not accept anything more, but the bottom line is, you know, whenever they start getting a whole lot of corn in and they've already got a fair amount of coverage out to the next 90 days, which I think is fairly common, Basis will have to widen because they're going to say pump the brakes, guys.
They'll be less aggressive.
You know, and if you want
less aggressive is what you.
If you still want to bring the corn, we're going to have to back this off just a shade. And so you pick up 15 cents on the board. Ultimately, if you continue the rally next week, you know, I think in some places you might lose half of the board rally in Basis alone. And so, you know, you got to be respectful of that and understand how that works.
Would you say bigger deal for corn or soybeans?
As far as Basis is concerned?
Yeah.
I would say for corn. I mean, just based upon what we heard about farmers selling today, you know, or on Friday. I mean, when that report came out, massive amounts of orders just on our platform hit. And so I know that was the case for Ted. I know that was the case for everyone that comes on here. And so obviously there was a lot of corn that changed hands today.
Yeah, I worry about soybeans too, though, because
I do.
You get the feeling, you look at the South America, you look at the Brazilian crop, and you say, well, our export window is coming to a close here fairly soon. And you saw a lower production number, but they didn't lower anything on the demand side of things. And I think that was a direct function of not raising Brazil yet. If they raised Brazil and cut our exports, you probably just saw the tightest or the smallest soybean carryover domestically that we're going to see. And I don't know, I don't feel like the end user is worried or panicking that the beans aren't going to be there, right? And so, I don't know, I worry about bean basis. I think we say both. But yeah, I worry about bean basis. And you look at the global carryover number, it really didn't come down much. I mean, it's a 128 and change. Look at 2 years ago, we were at a 101. You still have 28% increase in 2 years of the global ending stocks in soybeans. That's not a bullish picture, even at a 380 million bushel domestic carryover.
Right,
It's less bearish than it was,
Yeah, absolutely.
but it's not, oh my gosh, we're going sharply higher,
Yeah,
in my
think
opinion.
what it boils down to is if we're in a domestic situation that's a lot tighter than what it was before. I agree with Ted. This is probably the biggest stocks number we're going to see, or lowest stocks number we're going to see. I think it grows from here. I think you've got to worry about some cancellations once you get Brazil come online. I mean, clearly the real versus the dollar is like a 22-year low, and so that is going to factor in once they have available supplies. And so, I look at this whole thing, and you've got to ask yourself moving forward, what is it that is going to rally the market sharply higher? And so if we look at this, like Ted was saying, from a global standpoint, I think that corn has a little more of a story. You've got restricted global stocks. It didn't go down as much as you'd think, like 3 and change. But the problem is you've got a bean situation that the global supply, in my opinion, is going to be an anchor. So even if you have Argentine weather, even if Argentina's weather continues in a kind of an inclement deal and then they finish poorly, let's say we take 20% out of the crop. That gets them down to what, 40 to 42, and if they're at 40 to 42, we're still looking at 120 plus as far as global soybean supplies go, considering Brazil looks like they're going to raise one heck of a big bean crop. So I'm afraid this bean thing is going to be a bit of an anchor.
Yeah, so the global ending stocks for corn minus China is one of the tightest we've seen in quite a while. That's friendly, and corn still has the weather risk of Argentina, but then the second season Brazil crop.
Right.
So you can't say, oh, that crop's already there, like you can in soybeans.
You can in beans.
So there's that. Sorry, I'm going to take another question here, Paul.
Well, I was going to give you a question, but go ahead and do yours first.
Okay, thank you. So you talked about how corn was coming in with such low moisture content.
Yeah.
Same thing for beans.
Yeah.
What does that mean for you further on down the line?
Further on down the line, and who are you quantifying as you, though?
Is he farmer?
Well, what does it
Matt, or
mean
is
for the
he-
market? So, okay, let me. That means high oil content and high protein content.
Right.
Okay.
So you're not having to use as much of that as much raw bushels of soybeans to get that higher oil content and to get that high protein content. So if you kind of, and this is maybe a little bit in the woods, but if you kind of project that out a few months from our domestic demand, it wouldn't be shocking to me if our meal demand ended up being a bit less because you're getting that higher protein content. And soybean oil production might end up being higher than, versus like last year or the year before when oil content was a bit lower. So, to me, that's just another sort of negative connotation on demand longer term, just because you have that higher protein and oil content.
Right.
All right, I need to ask you about beans specifically here. Matt in Wisconsin's question, it's an extension, it's part B of what Ted's asking here. Soybeans seem to be the commodity to hate at the moment. Do you think that this has been overplayed and they will end up rebounding from too many acres going to corn? We haven't discussed acres yet in this discussion.
That's a good question, Paul. I think we kind of hit on a couple of those things. For one, if you look at the global balance sheets, the global corn carryover minus China, it's really rather tight. Global corn demand has been strong. And then we've seen about 1 billion bushel come off of our domestic carryover since we saw the Outlook Forum numbers back in February. The corn story's gotten quite a bit more friendly. The bean story's only gotten slightly more friendly. We were talking about 135 million bushel global carryover. Now we're at a 128. It's still a big jump over the course of the last 2 years. Beans are not in a position to really want to fight for acreage. So I don't really think that story's changed. There are things that could happen, right? There are things that, if we have this brand new, 45Z Part B that could be coming in a few weeks, on top of the newer the announcements from today and what might happen over the weekend, maybe that changes things. But I think for right now, no. Corn is the darling. Corn's the one that has the story, and the beans are just going to be a follower.
So, Matt, I'm going to ask you about acres for a minute on corn. What are you hearing, guys, in your area, south of I-80, north of I-80? Are they going to feed this narrative of more corn to come in 2025?
Right, so I was asked a question this week, that where are you coming up with all these corn acres? Whenever this particular person was in Central Illinois, they were a seed dealer, and they said, hey, I'm seeing beans to corn, corn to beans this year. Yeah, you are. for a guy that can grow 85 bushel beans, right? 85 bushel beans at $10 cash, if you're lucky, still is awfully skinny. And so you move north, for some of these guys north of I-80, and I'm not stepping on toes, but I have a lot of guys up in that area that will say into Minnesota and into the Dakotas and say, I can't raise, even 70 bushel beans. It might be 55, 60. That doesn't work at $10, but I can raise 230 bushel corn, 220 bushel corn. And so I do think the farther north you get above I-80, you're going to see a lot, and I mean a lot of bean acres evaporate this year. And so whenever we start talking acreage, I've got to think when you just go back 2 years. So in 2023, you were like 94.6. And so the natural transgression would be you dipped a little bit in 2024. You're probably going back up for a lot of folks in 2025, first of all. Second of all, just by rotation. Second of all, purely the economics of this makes it extremely tough at $10 beans. And even with a bit of a rally, Paul, you look at some of these break evens, you would have to rally substantially to get some of your folks that I would say can't raise really, really good beans. It's going to be tough for them to be able to make this thing work. So I feel strongly in some of your fringe areas, and especially the farther north that you get, that you're going to see a pretty big, just absolute dearth of soybean acres compared to corn.
Well, and I think today bought a lot of corn acres.
Oh, for sure.
I mean,
Even more than what was going to be there before.
Well, okay, so I think today, for any last-minute decisions that are being made, I think today pushed us more towards corn because there is more optimism in that market. We saw the potential for what corn can do. But not only that, and I think maybe more importantly in the short term, the Brazilians are going to max out that second season corn crop as much as they possibly can. They are going to be adding as many inputs with their currency being what it was, with their success in their export campaign that they had last year with China. I mean, the soybean that safrinha corn crop in Brazil, oh no, like this came at a really interesting time because now as they're getting ready to plant that crop, they are going to absolutely maximize it.
All right, so that's Brazil. I still have a bunch of stuff I have to cover. I can't believe I've lost my time. Did any wheat acres get lost in this today?
Wheat acres came in higher than expected. They've been doing that for the last few years. No, I don't think we're significantly losing wheat acres. I think the last couple of years when we were talking about acres, we look at it and we say, well, where are these acres going? Strip malls and things like that. No, I think we haven't had the urgency to plant everything we possibly can. I think now, after today, that urgency starts to come back a little. That optimism starts to come back a little bit.
Possibly, but I would say whenever you look at wheat, for instance, the one thing I pulled out of today is, you made a new contract low in front month wheat futures. Yeah. At the same time that corn and beans are just racing. And so, that Russian crop went into dormancy in pretty poor shape, according to most people. I do think later on down the road, maybe wheat will have some sort of a story. I mean, right now it looks awfully rough, but I think whenever it gets right down to it with acres, even at 450, and we can't lose sight of the fact that front month futures rallied substantially, whereas December corn could barely stay positive, But at the same time, there's enthusiasm for corn. I'll give you that. But once again, if I look at what does it take to be able to make money in 2025, most growers are going to tell you at today's prices, it's as thin as can possibly be. It just doesn't look as bad as what soybeans look.
All right, let's speak of making money. And in 2025, it sounds like it's going to be a lot like 2024 in the livestock market. Let's start with Ethan in Kansas, where they've been busy moving a lot of snow. He says, I have cows calving now. That's when the snow happens, right? When you're calving. What's the best way to protect the price of those calves weighing 600 pounds this fall, Matt? Puts are expensive that far out, and LRP doesn't give much protection on lighter weight calves.
Agree on the LRP with lighter weight calves. Totally agree with that. Whenever you start looking at, though, puts are expensive. I totally get it. But how much have feeders rallied here? You look and see what we've done just in the past 3 weeks. I mean, you look at feeders, you look at fats, and start thinking about, okay, whenever you get into this fat cattle market, the cash market is on fire, and you've seen overs. You don't see the convergence there. Be careful to assume that's going to happen forever, first of all, but you can stay bullish. There's nothing wrong with staying bullish, but don't do it without some sort of protection under yourself. If you think puts are too expensive, get a little more creative. Maybe buy yourself a put and sell something up above the market, because if the market rallies and you get capped out, now you're selling feeders even higher yet.
Yeah, I've actually been doing that a bit the last couple days is creating the window, right? You
Yeah,
sell.
for sure.
I was buying and this is all the way out in October. We're buying 268 puts and selling 280 calls.
Yeah.
The worst case scenario is that the market keeps rallying and I'm short at 280, which could create some margin issues. That's why I say worst. The other worst case scenario is that the market goes straight down and I've got short futures at 268.
Right.
I'm pretty happy with either one of those scenarios.
Oh, absolutely.
It's just a matter of that is for specific people that are able to understand the risks of being short that call and the margin possibilities and things like that. If you understand those sorts of things and you can tolerate them, I think that's a great way to approach the market right now.
Absolutely. The best thing that could possibly happen in that scenario is to pay margin calls. And some people don't, I mean, nobody likes them. But if you understand it, then you know that your cattle are worth more money because you're paying margin calls. So bottom line is stay protected and stay bullish if you want to.
And you're talking feeders and in cattle. Both, I mean, kind of some of those same philosophies are in hold on the technical
You're
side.
pushing up on all-time highs again,
Yeah.
Paul. I mean, I know I never got my $200 back in 2023, but
50
it
cents.
sure looks like we could push up and above here. Everything is on fire. We know that, but you got to be cautious here because the funds at some point will get tired of this long. It might be when the fundamentals are altogether as bullish as they are today. But if they do get tired of this long at some point and you have no protection under yourself, you're going to say, whenever we had $198 cattle, I didn't protect myself. What was I thinking about? So you have to have some level of protection.
When you wonder about the economy as we get into the new administration, I really do get the feeling that 4 years from now, things will be better than they are right now, and a lot of different fronts. But getting better or change and improvement, it's not usually comfortable, right? I mean, think about it, if you want to lose 20 pounds, at the end of that, once you do, you feel great, everything's better. But getting to that, you've got to go through some lean times. It can be painful, it can be uncomfortable.
Right.
I do wonder if we're looking at that sort of scenario for the economy as a whole, and therefore demand for things that are expensive, like high-priced beef, for example.
What about high-priced pork?
From a substitute standpoint, right? If you've got beef prices that are astronomical and pork prices that are relatively high historically, but not compared to where beef is.
Right.
I think you look at pork as being sort of that recessionary trade. I think a lot of the funds and the Wall Street guys have in the past, and when they start to get worried about the economy, they look at owning hogs because they feel like at some point, beef demand could start to collapse a little bit, and then it might go to the cheaper alternative, which is hogs and chicken, but we don't have poultry markets.
Well, but poultry markets, I mean, eggs, I mean, that's the Main Street story right now on the headlines of the main organizations of a dozen eggs over $6. The poultry, that is, where does that fit into this discussion with those who have livestock, cattle, hogs, and poultry? What are they doing right now, Matt?
That's a tough question. I mean, ultimately, everything is high priced. We know this. I mean, and to go back to what Ted said, I mean, there's no doubt. It seems to me like hogs, in my opinion, wouldn't be quite as strong as they are right now if we didn't have cattle prices where they're at today. And so I think, if anything, for one of these guys thinking, I want to own pork in some sort of recessionary deal, I'd be looking at maybe owning pork and maybe selling cattle and looking at some sort of a spread trade. But bottom line, everything's expensive. That's all there is to it. And so every facet, in my opinion, should have some sort of level of protection, because if Ted's correct, and I feel the same way as he does, you could be looking at a lot of things kind of deflated at some point because we're overinflated right now.
Speaking of, in the last 30 seconds, deflated dollar at the beginning of the week, rallied at the end of the week. The dollar lowered because the incoming president said, no, those tariffs are going to be a little more specific. Is that going to be the biggest mover of the dollar here in the next 6 weeks?
Well, what are we going to do with interest rates, too? I mean, that's usually the biggest mover of the dollar. Are we just going to pause on interest rates? Are we going to see things come down? Or do we get more concerned about inflation again? And do we start to see interest rates go back up, which is kind of where I think we should be headed? I don't know. I'm really curious to see how the dollar trades going through the next few months. But I would think that I would lean towards more strength in the dollar coming.
Okay. Good to see you, Ted. Thank you so much for your time.
Always a pleasure, Paul.
Oh, it goes fast, doesn't it?
It does go so fast.
That's Ted Seifert. That's Matt Bennett. Matt, I appreciate your time as well. Thank you.
Absolutely.
All right, we are going to continue because we have to pause right now, this analysis, but we will, as I say, continue our discussion about these markets in our Market Plus segment. You can find both analysis and plus on our website of markettomarket.org. We have a way you can get our content to your pocket. Subscribe to our YouTube channel and be sure to click notifications, and you'll be fed our full program, stories, and podcasts, especially if you've missed the airing of our program on your local public TV station. Watch early and often when you head to youtube.com/market-to-market. Next week, a professor hunts for unintended changes from genetic editing. Thank you so much for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because at Pioneer, our name is our mission.
For over 45 years, Steiner Tractor Parts has shared your love of antique tractors. New parts for old tractors. Learn more at steinertractor.com or at 877-559-7887.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.